Alright, yo, what is up guys? Welcome back to another video. In today's video, we're going to be going over an ICT strategy that pretty much never fails. Now, this strategy is called the unicorn model, and it has literally around a 91% win rate. I'm not even joking. Okay, so we're going to be doing a little PowerPoint for this video, pretty much explaining a full A to Z guide on how this strategy works, giving you a full risk management plan, stop loss, where to set your take profit levels, where to take partials, and pretty much just fully explaining this model in depth, as a lot of people on YouTube have tried to explain it and they've just overcomplicated the full model. But yeah, just a lot of people on YouTube have misinterpreted or misinformed viewers on how this strategy actually works and what it is. So in this video, I'm going to be explaining that, and I'm going to be clearing things up for the viewers. So let's get into the PowerPoint, and after that we're also going to be going over a few chart examples, so stay tuned. Alright, so let's start off with what is a unicorn model in the first place. Now, a unicorn model consists of a breaker block and a fair value gap. Now, I hope that most of you know what a breaker block is. Now, if you don't know what a breaker block is, head over to ICT's channel and go watch his core content mentorship, where he explains what a breaker block is. Now, these two PD arrays must be overlapping each other in order for the setup to be considered high probability. Okay, so if you are feeling a little bit confused right now, just bear with me. In a second, we are going to hop into some chart examples and show you exactly how this model works. Alright, so before we jump into the chart examples, I just want to show you a more beginner friendly, pretty much diagram kind of breakdown of how the unicorn model looks like, so you guys can get a better understanding. So as you can see here, you have your high I was talking about, low, high, and then this is the displacement leg, right? Now, as you can see, the breaker block here is overlapping with this fair value gap, okay? And that's why it's such high probability, because they're overlapping. Now, whenever they aren't overlapping, obviously you can still take the trade, but it's going to be less probability. So that's pretty much a bearish example. And that is your breaker block, okay? The down close candle is your breaker block, the last down close candle before the move lower, okay? Now, this is vice versa in a bullish example. So you have a low, a high, a lower low taking this liquidity, and then a high displacing through that high. And this actually looks more clearer than the bearish example, as the fair value gap, there's more range, right? Here there's just a tiny fair value gap. This is more of a natural imbalance in price. So whenever you see this and the break block is perfectly overlapping and aligned with the fair value gap, that is a very high probability setup, and 9 times out of 10 it's going to go towards your take profit, right? In this case, your break block will be your last up close candle. So this swing high here that is broken through, you want to pick the last up close candle and draw that to the side. That's your break block, and this is your fair value gap. So hopefully that made sense for the beginners. Now, in the next slide, we're going to be talking about stop loss placements, take profit placements, where to take partials, and we're going to be also providing you a full risk management plan for this strategy. So let's get into it. Alright guys, so I'm sorry to interrupt the video, but we have a big announcement. Live trading will be coming to the Inner Circle signals chat. So not only are you going to be receiving my live signals, but you'll get to watch me live trade every single morning for the New York session. So you're also going to be able to get the opportunity to learn the reasoning behind my trades and watch me perform it live. Don't worry, I will still be sending in the signals into the chat for those that can't tune in to the live. However, I am very excited to introduce live trading to the chat, as a lot of people have been waiting for this moment, and today the day has come. And in order to celebrate this, we're actually going to run a 50% off sale for the lifetime access subscriptions. So price is currently at $300 a one-time payment. We're going to be reducing that to $150 one-time payment. This is the lowest we've ever gone for a lifetime access, so make sure to take advantage of that, because we're never going to be reducing this price that low ever again. I'm not sure how long this sale will last. We're most likely going to put the prices back up around 24 to 48 hours after this video is released. So if you are serious about getting your trading to the next level, make sure to secure your spot. Now, anyways, I wanted to share some of this week's results. Monday, we took a short trade, secured 21.25 points. Tuesday, we took a short trade, ended up being a loss for 7 points. Okay, so this is why it's important to have correct risk management, as this didn't really affect us. Now, we took another trade after that, another long, which was a win, ended up securing 19.50 points. And then we took one more short trade that ended up going for 30 points. Wednesday, we took a long, securing ourselves 34.25 points in the bag. Thursday, we took a short trade, secured ourselves an easy 30 points. And Friday was a very good day for us. We took a short and we ended up closing that for 52.75 points. So overall, this whole week has been amazing. We've had a total weekly gain of 180.75 handles, which is very good for a weekly profit. But anyways, the links for the free group and the inner circle VIP group will be in the description. Make sure to go join that, and let's get back to the video. All right, so I've created a risk management plan for a 50k top step account as an example, as the majority of the people that join my signals group usually start off with, you know, a 50k account, very cheap to get with TopStep. I think they're around $50. So these accounts usually have a drawdown of 2.5k, and the target for this account to pass is 3k. The max contracts that you should be using on an account like this would either be 1 mini or 10 micros. Now, I'm not actually sure if TopStep allows you to use 10 micros. I think Apex does, but TopStep doesn't, so you might have to just use 1 mini. But if you are allowed, I would highly recommend using 10 micros, as that way you can take, you know, partial profits. Now, your max risk should be no more than 25 handles if you're trading the Nasdaq, or 5 handles if you're trading the S&P. And your max risk should be $500 per trade idea, okay? No more. If you're doing anything more than $500 on a 50k account, you're over leveraging and you're most likely going to blow that account. Okay, and lastly, if you take a loss, you want to half your risk down to $250. So that is around 5 micros, and you want to stay there until you have your next win. Once you have your next win, you can bump up your risk back to 10 micros or 1 mini. And this way you have less chance of blowing your account, right? It's correct risk management, and you're actually trading. Okay, you're realizing if you take a loss, you're not doing so well. What's the point of risking more of your capital? Let's half your risk, keep trading, and once you have your next win and you're more confident, okay, then you can bump up your risk back to $500 per trade idea. Okay, so you can screenshot this, guys, save this as a risk management plan. If you are trading a higher account than 50k or even a live account, text me on Telegram at BK0111 and I will create you your own personalized risk management plan. All right, so now that we've gone over a full risk management plan, let's go over stop loss and take profit levels. Okay, so let's talk about stop loss placement. So a valid stop loss for this strategy would be above a recent swing high if you're bearish, or below a recent swing low if you're bullish. Now that's the basics, but it does get more technical as well. If you have a bearish scenario and you get a fair value gap, which is obviously a 3 candle formation, the minimum stop placement would be above the displacement candle's high, or if you want to be safe, put it above the first candle's high that made the fair value gap, if that makes sense. Bullish scenario, the minimum stop placement would be below the displacement candle's low or the first candle's low. Now, you do also get rare cases where these stops are just too large and you're risking way too much money. Now, in this case, you can just set a 25 handle stop if you're trading NQ. So this would be a 5 handle stop if you're trading ES, and just accept the risk. However, that way your stop is not in a valid place. Now, if price comes down and stops you out, it can still head in your direction. Okay, so I don't really like doing that, and I tend not to do that, but I know some people that trade like that and it works for them. So that is in very, very rare cases where stops are just too big, but usually you won't get that. Usually you'll be risking around 17 handles, 18 handles. But yeah, your max risk is supposed to be 25. But yeah, I wouldn't really worry too much about this. Usually you would have a valid stop, just setting your stop above a recent swing high or recent swing low, risking around 25 handles. So don't worry about that. That's just there for you to screenshot and add to the model. Anyways, let's get into take profit placements. Take profit placement. This is going to be a bearish scenario, right? So everything I say, you just want to make it the opposite for a bullish scenario, okay? So TP1 is always at either a recent swing low or at 50% of the range in a discount, okay? So if the recent swing low isn't providing me more than 25 handles profit, I usually won't have my take profit there. So let's say if it's like 13 handles away from the swing low, I'm not going to have my TP1 there because it's just not giving me a good amount of profit to be able to actually be profitable on that trade. So if that is the case, then I'll usually have my first TP at 50% of the range. Now, last week we took a trade inside the live signals room and our first TP was at recent swing low, and that recent swing low was around 50 handles, okay? So and we hit that TP. Now in that case, yes, I'll put my TP at that low, okay, because it provides me an easy 1 to 2 risk to reward and a good amount of profit to actually be profitable on that trade. Okay, so hopefully that makes sense. Now, once TP1 is hit, you want to take partials. Around 50% of your position comes off, and you move your stop to a protected swing high, reducing risk. Now, final TP is where it gets juicy, right? This is when it's at an external sell-side liquidity range, or at a daily drawn liquidity that you believe where price is most likely to draw to. So, example of this is relatively equal lows. You think price is going to draw there? That is where my final TP is most likely going to be. Obviously, once price moves further than TP1 and I'm floating a lot in profit, I'm going to take some of that position off as well. And I'm usually around 80% out of my position before I let my final 20% run to final TP. Okay, that's just how I trade. I know some people don't like to take partials and they will take full profits at final TP. That's totally fine. You can do that, but obviously your win rate is going to be a lot less lower compared to if you take profit when TP1 hits. And that way, even if you're wrong, you still hit TP1, you've taken off partials, you've moved your stop, you've reduced the risk, and even if price does come back up, you're still profitable. Okay, even if you're wrong, you're still going to be profitable. And that's why this strategy has such a high win rate. Okay, anyways, we've gone over everything that you need to be successful with this strategy. Now we're going to be jumping into some live trading examples. Okay, so welcome to the first example. This is going to be a bearish unicorn model example. Now, first things first, what I do in the morning is I hop into the daily time frame and see what our bias is, okay? Because bias is very important. You have the correct draw on liquidity, your trades will go a lot more smoother and will be hitting TP a lot more faster, okay? Rather than trading against that, which is more risky and more trickier. So what I was thinking going into the morning is we have this high time frame market maker sell model happening here, right? So this swing low here, I was waiting for this to see how it reacts, see if these bullish gaps would get respected and if we would continue this trend higher. Okay, so right now we are in a bullish institutional order flow. That means down close candles are supporting price and we are heading higher. Now, if we broke below the swing low, automatically I would be bearish because we've now had a higher market structure shift on a higher time frame. We can expect to attack these lows down here. This could be our next draw on liquidity. So I was waiting for this candle pretty much, and once I seen this on Wednesday, I knew that going into Thursday, I'm going to be bearish bias because we've broke below this low and we are likely to take out these lows before retracing into a premium. So anyway, now that I've figured out my bias, hop down into the 15-minute time frame and mark out my key liquidity levels. So this right here was our London high on Thursday. If you don't know, a London session is from 2 AM to 5 AM. So any high or low that is formed inside that session, you can use that for the next session, which is New York. I'm pretty sure this was Asia's session here as well. A lot of accumulation. These levels weren't important to me. I was only focusing on Wednesday's low, so the previous day low, as my next draw on liquidity. Obviously, we had them daily lows, which were further below this low, that I'm not going to aim for because you'd have to hold price for a longer period of time, and I'm not a swing trader, right? I'm a day trader, I want to be in and out, so I'm going to be aiming for the most closest objective, which is this external sell-side liquidity level here. All right, so going into the morning, I was waiting for London high to get swept. Unfortunately, we didn't actually sweep London high, and we left equal highs. So I was thinking, okay, we may retrace and then come back, sweep these highs, and then displace. However, we didn't do that. We displaced straight away. So automatically, I knew, okay, price is accelerating lower here. I'm going with price, I'm not going to go against it. So I kept my bias. I was looking for my model and I was waiting for a more of a displacement for this to become a unicorn model. So a unicorn would be high here, low, high, high, displacement through this low. This down close candle here, as you can see, would be your breaker block, and then you have your fair value gap, right? So you get your displacement and your fair value gap. Now this looks a lot clearer on the 5-minute time frame. You can use this high here, low, higher high, displacement, fair value gap. And as you can see, this down close candle is overlapping perfectly, okay? It's overlapping perfectly with this fair value gap. And that is exactly what you want to see. Now, obviously, if you were to enter from the 5-minute fair value gap, you'd have a very large stop, which is way too much. 45 handles is way too much. That's not part of our risk management plan, so we're not going to be taking that. You can take this and just set 25 handles stop, which I don't recommend doing. So what I actually did was I hopped down into the lower time frame. I measured from swing high to swing low to get 50% of the range, and I was watching this fair value gap right here. Okay, so as you can see, this fair value gap is in a premium or at equilibrium, and I was waiting for price to come up inside of the 950 to 1010 macro here and give us an entry. Now the macro times have slightly changed. You can add 5 minutes before and 5 minutes after. That's what I recommend. So 9:45 to 10:15. So let's see if price give us an entry here. As you can see, price came up inside of that time window, give us an entry, and right here you could have your short position off this fair value gap. Stop placement either above the displacement candles high or above the swing high, right? So 26 handles is around 25, or you can risk 20 handles here, displacement candles high. First TP could be this swing low here, but why not just aim for this low here, right? So 70 points would be your first TP, and that would be where the majority of your position comes off, as it's 70 handles is quite a lot. So I'd be taking around 80% of my position off here. If your first TP was at this swing low, I'll take around 50, then take another 30% here, and obviously let the rest ride to that external level. Okay, so let's see how this plays out. Okay, and look at that. As you can see, we don't get stopped out. First TP gets smashed, and we're going to let the rest of this trade ride towards final TP, which is at around 120 handles. Okay, so I'll be out around 8% of my position here and let the rest ride. So maybe leave one contract, leave a runner towards that final TP, and boom, there you go, it gets smashed, right? So you can still be in this and you can be targeting those daily levels. However, me as a trader, my goal is to catch a portion of the move, okay? Catch a piece of the pie. And this is this piece. I'm happy with 120 handles. That is a very respectable amount, okay? I don't need to catch the whole 300 handle move to be profitable. You don't need to do that, guys. Just catch a portion of the move and be done for the day. Be content. So that is what we've done here. And that is a lovely first example for a unicorn model. Now this also happens on a lower time frame. Of course, this was a 5-minute and a 15-minute unicorn model, and usually you would have your entry off of that fair value gap. However, the stop placement was so big, you have to jump down into a lower time frame to get a more precise entry, if that makes sense. So anyways, now that you've seen a bearish example, let's jump into a bullish one. Okay, so the video is getting a little bit long here, so I'm going to make it nice and brief. Anyways, this is a bullish example, okay? So obviously you have your low, your high, lower low, and then your higher high. Now, I want to make something clear. Your higher high has to have clear displacement, okay? Which usually will leave imbalances in price. And there you go, you have your fair value gap and your breaker. Your breaker would be this up close candle here. Why not this one? Because this is the last one, okay, before taking out liquidity, and it's nearest to this high, okay? So you want to choose this up close candle, and this is your bullish breaker. All right, and this example isn't the best, but this would be your fair value gap. Now, usually you'd want it to be overlapping with each other. However, this still is a valid unicorn setup, just it's going to be low probability than it would usually be, right? However, this is still a very clean setup, as you know, this bearish fair value gap has been inversed now, and we've got clear displacement. So in this case, we're trading at all-time highs, so there's no more buy-sell liquidity to the left of us. So I would be entering here off of this fair value gap, stop placement just below the displacement candles low, risking around 16 points, and my take profit would be the recent swing high here, so 28 handles, okay? All right, we're gonna get tapped in there, and boom, TP smashed within a couple of candles. TP1 has been hit. Obviously, there will be no final TP as we are trading at all-time highs. There's no more buy side to target, okay? But yeah, guys, that's gonna be it for today's video. I hope you learned something and this made sense. Please make sure to leave a like, comment, share, and subscribe, and I will see you in the next one.